Hello, and welcome to the February market update from Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. Once again, I'm happy to tell you we had a great month for the financial markets. Almost everything was up, and this after 3 very bad months at the end of last year. We saw U.S. markets up between about 7 and about 10%. We saw international markets up 6 to 10%, and even fixed income made money. We haven't seen a month like this for a while, so it was a really nice month to look back on. And the thing is, we got this rebound, we got this terrific month, despite all of the bad news. Despite the government shutdown that everyone was hyperventilating over. Despite some very real signs of an economic slowdown. Despite the fact that consumer confidence and business confidence dropped down. And despite all the weakness we've seen in China and Europe. Everyone was worried, everyone was scared, but somehow the markets went up. And the question is, why did that happen? Well, first of all, not all the news was bad. In fact, we saw terrific job growth. We saw wage growth pick up to a level we haven't seen in years. So from the consumer's point of view, from the worker's point of view, everything was actually very, very good. We saw progress on trade. We saw companies actually making more money than expected. One of the results of the worry that we had at the start of the month was analysts were thinking companies weren't going to do that well, and in fact they did better than expected. In other words, when you look at the actual foundations as opposed to how people felt, the foundations were actually quite solid, and we saw that throughout the month. And once the markets really got a grip on the fact that, yes, the fundamentals are there, they calmed down, and once they calmed down, they started to move back up. Now, that's not to say all the news was good, but at the same time, in some respects, all of that worry, all of that bad news actually was constructive. Because one of the big stories for the month was that the Federal Reserve actually backed off from some of its planned policy tightening. There were concerns at the end of the year that the Fed was going to keep raising rates. But at the end of the month, they said, no, we're going to take a pause. There was concern that the Fed was going to keep dialing down its balance sheet, making money more scarce and more expensive. And at the end of the month, markets heard the Fed say that, no, we're actually not going to do that. So in that sense, the bad news actually led to a good outcome and helped. Now, what does that mean for us today? First of all, the fundamentals continue to be solid. We've got the jobs report coming up. That's expected to be strong. Consumer confidence and business confidence, even though it's pulled back a little bit, still remains at very solid levels. And we've had some weak areas, such as housing, show some signs that they might be improving. So when we look at the fundamentals, they continue to improve. When we look at sentiment, how people feel, not only have things improved, they're also a little bit more in line with the reality of how the economy is going. And that's a good thing, because when markets are kind of out of line with the reality, that's when they move up and down. When they're more or less in line, that's when they can just show steady progress. As we end January and start February, we're actually in a pretty good place, with the fundamentals are solid, and the outlook is a lot more positive than seemed possible a month ago. With that, we'll have to wait and see what happens, and I'll talk to you next month. Thanks for watching.